Want cash without monthly payments? Sounds good to be true, right? Well, we're talking about the home equity agreements or HEAs, but are they a golden ticket or a ticking time bomb? Let's break it down. I'm Abel Tejeda with the eMortgageGuys, and I help homeowners make smart money moves with their equity. And one option more and more people are asking me about lately are HEAs, or home equity agreements. Instead of taking out a loan, basically what you're doing is you're partnering with an investor. They give you a lump sum of cash now, and in return, they get a share of your home's future appreciation or of your future equity. No interest and no monthly payments. But before you jump in, there's a catch, a big catch, I would say. These loans work very differently than a traditional mortgage, and understanding the details is crucial to avoid a financial headache down the line. Some of the things you have to be careful with and pay attention is, number one, that you're sharing your appreciation. So basically, the investor shares a percentage of your home appreciation or of your home equity. So if your property goes up in value, you end up giving up more to the investor. So it's one of those times where you really don't want, it's a double-edged sword, because if your property goes up, you're happy, but then again, you share more or give up more to the investor. Also, these loans have a payout timeline, meaning it can be 10 or 30 years. You can't get out of the loan unless you refinance and you pay back the amount that you borrowed plus the shared appreciation, or you sell the property. And then there's the valuation risk, especially at the end. Well, actually both, and at the beginning or at the end. You have to be very careful, because when you go into these loans, a lot of times the companies, and there's not just one company, there's multiple HEA companies, they tend to value your property lower than what it is. So you go into the loan already with built-in appreciation or built-in equity that you're giving up. Here are 3 things you should know about these loans. Number 1, the investor shares in your home's appreciation. So they're basically becoming a partner with the lender. If your home value doubles, they get the agreed upon percentage of that increase. Especially right now, with home appreciation being so high, the more your home appreciates, the more you share with the investor. Another thing is there's a payout timeline. These agreements are long-term, often 10, 30 years. You'll need to buy out the investor or sell your home if you want to get out of this loan. And then there's the valuation risk. How your home is valued at the end matters. And even the way your home is appreciated, or the way it's appraised initially, matters. So you have to be very careful, because a lot of times, let's say your property is worth $500,000, they will give you a value of 400. So there's already built-in equity. Those are things you really need to pay attention to. But remember, even though you're getting cash and there's no monthly payment, it's not all rainbow and butterflies. You have to be careful. Why? Because you have to pay back the amount that you borrowed. And also, you have to give a percentage of your equity. So you're basically paying the whole loan plus interest, let's say, even though there's no interest, let's just call it that, at the end when you end up either refinancing or you end up selling. So you have to be very careful. And with these loans, you really need to read the fine print, because they tend to be more complex than just traditional financing. So bottom line, HEAs can be a useful tool, but they're not for everyone. Do your homework, understand the risk, understand the way it works, and make sure it aligns with your long-term financial goals, because knowledge is power and clarity is key.